Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing GlaxoSmithKline stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. GlaxoSmithKline is a pharmaceutical company. The company is headquartered in the UK and was founded in 2000. Its predecessor company went public in 1975, and it currently trades on the New York, Deutsche Börse, London, and Swiss stock exchanges. It was established in the year 2000 by a merger of Glaxo and SmithKline. It is the world's sixth largest pharmaceutical company after Pfizer, Novartis, Roche, Sanofi, and Merck. The UK government ordered 60 million doses of the COVID vaccine developed by Glaxo and Sanofi. Let's get started with the model. This is a large cap company, 95 billion market cap. They're trading at $37.70 a share, and they have 2.5 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have a ton of free cash flow, $6.6 billion in 2017. It peaked in 2018 at $9.3 billion, but it's still a really high number at $8.7 billion. Net income is the profit and loss on the income statement. It's revenue minus expenses. That's also positive and growing each year, up to $8 billion. Revenue is the sales for the company, and that does grow from 2017, $42 billion, up to $47.7 billion. This is the company's income statement. All their numbers are in British pounds. I converted their numbers to US dollars on my Excel spreadsheet. The top number is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And the difference is the gross profit, and that grows each year, peaking in 2020 at 22.4 billion pounds. Below that is operating expenses, and then operating income, which was the highest in 2018 at 7 billion. They paid $856 million of interest on their debt, which is a little lower than 2019. And the bottom line of the income statement is their net income, which was 5.7 billion, more than triple 2017's number. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. And then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. That peaked in 2018 at 6.6 billion pounds. Currently it's 6.2 billion. They do pay a pretty big dividend, so a lot of their free cash flow goes towards their dividend. But they paid down a lot of debt in 2020. They issued 3.3 billion, paid down 7.3 billion. They increased their debt 3.5 billion and 8 billion in 2018. When a company has a lot of free cash flow and takes on a lot of debt, it's probably to acquire another business. Let's look at the capital structure. 20 billion of equity, 38 billion of debt. They're 35% equity, 65% debt. Their net debt is 29 billion, and their WACC is 7.4%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 213 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $193 billion. We divide that by 2.5 billion shares. And we get a calculated stock price of $77. They're trading at $38, so they're trading at a 51% discount. It's a strong buy according to the model. Simply Wall Street is really close to me. They're at $77 a share. They're also saying the stock is really undervalued. This is the stock price the last 5 years. So you can see it peaked at about $47, $48. Then it dropped a lot last March. It's come up a bit, but it seems to be struggling. It looks like it's at a great value. Plus you get a really sweet dividend payment. Their dividend yield is 6.66%. That's a really high dividend. They pay out 79% of their net income and 73% of their free cash flow. Simply Wall Street has their dividend at 6%, which is much higher than the industry average of 2.7%. Analysts are forecasting their dividend to decrease to 5% in the next 3 years. They have a really low beta, 0.36, so the stock is not volatile. It moves about 1/3 of the market. The stock has gone down 10% in the past 52 weeks, while the S&P 500 went up 44%. The 52-week low was 33, the high was 43. Although the stock is trading above its 50-day and 200-day moving average. About 4.5 to 6.5 million shares are traded each day on this stock. Of the 2.52 billion shares outstanding, 2.45 billion are on float, 12% are held by institutions, and over 1% of the shares are shorted. In the past year, this stock has gone down 5%, while its industry went up 12.6% and the market went up 57%. In the past 3 years and 5 years, this stock has done worse than its industry and the market. Analysts are forecasting their earnings to grow 5%, its industry 18%, and the market 17%. Analysts are forecasting their revenue to grow 4%, its industry 5%, and the market 10%. In the past 5 years, their earnings grew 46%, while its industry 21% and the market 12%. In the past year, their earnings grew 24%, the industry decreased 2.5%, and the market grew 8%. If you invested $10,000 into this company 10 years ago and reinvested your dividends, you'd have about $15,000 today. That's a 4% annual return. Dodge & Cox is the biggest shareholder at 8.2%, then BlackRock, Capital Research, Vanguard, and State Street. Let's look at their financial ratios. The average PE in the market's 33, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 11.8, so investors are paying $11.80 for $1 of earnings. That's a really good price to earnings ratio. Price to sales is 2.0, which is also really good, and a good price to book of 4.7. Price to book is stock price over book value per share, and the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $20 billion of equity, negative $36 billion of tangible equity, since they have a lot of intangible assets on their balance sheet. A company gets an intangible asset when they acquire another business. Their return on invested capital is a solid 16%. They can cover their interest payments 7.3 times, and they have a great ROE at 39%. Their current ratio is below 1, so they can only cover 90% of their current liabilities with their current assets. Their current assets are 6.2 billion pounds of cash, 6 billion of inventory, and a few other smaller current assets. The company seems to be undercapitalized. They had 8.7 billion of free cash flow. They have negative $2.7 billion of working capital, and they pay $6.3 billion in dividend payments, so they're short $300 million. They may need some more debt in the next 12 months to run their business. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 13 companies in the same industry as GSK, and if GSK has a number in blue, they're better than the average. If they have a number in red, they're worse than the average. They're a lot better in all the price multiples, mainly because their stock price has come down so much, which makes these ratios look better. They do have a low current ratio. They're doing well in ROE. They're a bit higher in debt than average. And they are a big company at 95 billion market cap, but that is smaller than average. The average number is 150 billion. And they pay the biggest dividend of all the companies, 6.66%. So to summarize, I have them trading at a 51% discount. This is a really big company that's been around a long time. This is not the stock you're going to 10x your money. You might have to wait a decade to double or triple your money. And a big reason is they pay out a lot of their money in dividends. So every time a company pays a dividend payment, the stock price goes down in relation to the dividend payment. But I think this is a great company, and it's a good long-term hold. I rank their free cash flows 8 out of 10, their revenue 8 out of 10, and their ratio is 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.